Monday, June 13th, 2022, Monaco 64, home of alternative economics and contrarian views. So the world is in a dangerous spot, I would say. The financial world, that is, of course. My feeling is if central banks don't raise rates a lot quicker, we could go into a crack-up boom, a loss of confidence in the currency. But the problem is if they do, the whole house of cards comes down, collapses. And either way, the crack-up boom will also be a collapse. And all the symptoms are there. It's not good. And today we've had the latest data for the UK economy, for which I've been warning for months about. I started warning last September that we could be on the brink of collapse. And today the government's own figures, not mine, show that the economy shrunk in April. GDP shrunk by 0.3%, was expected to rise by 0.1%. Of course, the FT calls it unexpected. The FT, of course, are a bunch of globalist Keynesian economists. They will be shocked, I think, in the coming months or year or so, how actually it's a slow economy or even an economy shrinking massively that triggers the crack-up boom, the loss of confidence in the currency. So we're going to look at the markets as well. The markets are getting very interesting. I've spoken in the last week or so about the Italian government bond market, how yields there have been rising rapidly. And I spoke about that yesterday on my live stream, which I recommend you watch if you haven't. I spoke exactly about the sovereign debt market. So I'm not going to get into it here. You can go and watch my live stream. But suffice it to say, bond yields are continuing to rise very rapidly this morning. Not just in Italy, but U.S. Treasury yields are rising. U.S. Treasuries, of course, trade almost 24/7. Yeah, JGB yields are being capped, but they're trying to break through that 25 basis points to 10-year. And we're seeing the dollar continue to rise quite sharply against the yen. We got up to 135. Of course, if the Bank of Japan wants to strengthen the yen, they're going to have to let yields go and stop QE. But it looks like they want to have their cake and eat it. So before I go into what's going on this morning in the markets, just want to say that this morning I actually went out before starting or preparing for this report, and I drove to the local gas station or petrol station, as we call it in the UK, because someone in the live stream noted that petrol stations are charging as much as £2.50 per the liter of diesel, and I thought that was like, wow, that's big, because last week I put some diesel at just over £2. I think it was 203.90 or 203.20 in pence. So I wanted to see if it was the same thing around where I live, and it wasn't. It had gone up. It's now 205, the diesel that I put in, and so I did that. Because if it had gone to 250 here as well, then I would have been concerned. Things might be getting worse very quickly. But I found a story about this petrol station. It's one petrol station in London, in Kensington, which is West London. They're charging $2.39 per liter of petrol. That came out yesterday. Here, as you can see in the Metro newspaper. There you go. But I think it's only a matter of time that when other petrol stations are going to join in. And I wouldn't be surprised to see £3 petrol by the end of the year. That's how bad it's going to get, I think. And even worse maybe next year, who knows? And that's going to cripple the economy even more. And I think the stagflation we're going to get is going to be much worse than in the 70s because we got so much more debt. And of course, the Bank of England is expected to raise rates this Thursday. Some people think they're going to raise by 50 basis points. The expectation, market economists' expectation is that they're going to raise it from 1 to 125 or just 25 basis points. Yesterday in my live stream, I said I think they're going to raise by 50, and I'll stick to that. And that's why there's a problem, because prices are rising, or what they call inflation, are rising by double digits now. You can't say it's just 8 or 9. It's more like 12, even 15. And the Bank of England rate is only at 1%. So, as I said in the beginning of this report, unless they raise it to 5 this meeting and then 10 the next, and rein in rising prices, we're going to see the crack up boom. I don't see any way out, unfortunately. And politicians, they never like deflationary depression, because governments are the biggest borrowers, and especially now. And in the UK, house price values are very important. There's the old saying that a home is an Englishman's castle, and you mess around with a housing market, and you can bet you're going to lose the next election. So I think they're going to keep inflating the system. Yes, they're raising rates, but it's still very cheap to borrow. You're getting paid to borrow because rising prices or inflation is at 10, 11%, and the rate of interest is only at 1%. So you're getting paid like 10% to borrow. So people are not going to stop borrowing, especially now that they're getting hard up. They're going to have to borrow. And I think the whole problem really is big government, not just here in the UK, but all around Western Europe. And the government has gotten up to here in debt. And with bond yields rising rapidly, governments are going to have even more trouble. So, yeah, these are really interesting times, I would say, financially and market-wise. I've never seen or experienced an environment like this, and I was in the markets for 25 years, following markets, the economy as well. That's the other thing I did. I followed geopolitics, the economy for all my clients. My clients, of course, were institutional clients. They were professional clients. They weren't private clients. And it's one of the reasons for this channel. I'm trying to let the public know what's going on as if you were one of my institutional clients, which I mean people working at banks, at corporate treasury offices, mutual fund managers, and the like. So let's look at where we are then this morning. And we're going to start with the bond market, because I think the bond market is the most important market out there, even though the general public follows just the stock market. The bond market is much bigger. It's where the price of credit or money is set. And if yields are rising, that means governments, individuals, corporations, and think of buybacks for corporations. They're going to be paying a lot more to borrow funds. And a lot of times corporations, they borrowed very cheaply in the last 10, 15 years in order to buy back their stock. So when the cost of borrowing is rising like that, you can bet it's going to have the opposite effect on the stock market. So we're going to start with the Italian government bond. So I told you that the 380, 83 level was going to be important, that we could go through that very quickly. And last week when I first covered the Italian government bond market, the 10-year yield was at 340. Well, right now The 10-year yield in Italy is approaching 4%. It's at 395, up just over 10 basis points. So that's very bad. Let's look at the UK gilt market. Yeah, that's a little more under control, but it's still not good. We broke through 2% a couple of weeks ago, and we're now almost at 250. It's at 249. It's up 4 basis points, and I expect that to continue rising. That, of course, it's going to have a major effect on housing, borrowing. The UK is an economy that's driven by a lot of credit, mortgages, credit cards, and people now are even buying normal goods on credit, which is crazy. It just goes to show how people are hard up. They've got almost no discretionary spending power anymore. I saw a young woman on TikTok. She works as a barista. Yeah, I know it's not a high-paying job, but it is a job, and she only has about £50 a week left to buy food and other little discretionary spending that she does, and she has to basically share an apartment or home with 5 other people. Her rent is £750 a month. So yeah, you know, there's a lot of people in a bad situation here, and it's going to get worse, unfortunately. So yeah, the 10-year yield as well, we're rising quite sharply today. We're approaching levels that we last saw in 2018 when things started turning around and the Fed had to start thinking about pivoting, because they were trying to raise and do QT around that time, and we got to 325. Well, this morning we're at 320, the 10-year yields. That's the highest level for the year. It's up 5 basis points. And of course, bond yields, especially the 10-year, affects all other financial assets. It's the rate at which stock prices are discounted at. So if yields rise, the discount rate goes up, and prices, forward-looking prices or stock prices go down as well. And that's what we're going to look at now, where the markets are. Yes, gold and silver did very well on Friday, despite meltdown on Friday as well. They rebounded very well after the CPI numbers. And this morning, though, they're back down, but I expect them to continue to do well, and I expect commodities to continue to do well, not today but in the long term. I think we need to hang on to commodities, hard assets. That's where the action is going to be. That's where you've had bull markets during deflationary periods like in the 30s and stagflationary periods. So either way, commodities will do well. I'm going to put a link to an article about that below in the description so you can read it. So it's 8:39 a.m. London. Gold is down about $11. It's trading at $18.60. The low, I think, on Friday was $18.24. So keep that in mind. We're still a lot higher than then. High today or overnight has been $18.80. We're right near the lows here at $18.60. Silver is down 35 cents at $21.53. It's down 1.6%. High's been $22.08 and the low $21.50. Now to the interesting part here, the stock market. The Dow futures down 500 points, 1.6%. NASDAQ 100 future is down 2.3% or 283 points. The S&P 500 is down 2% or 79 points at 3820. The FTSE is down just over 1% at 7232. Euro Stocks 50 is down 1.7% at 3533. Now we move to the currencies. Sterling is down 0.5%, 122 22.64. The euro is down a third at 104.82. The dollar is up 0.25% versus the yen at 134.76. Dollar's up a third versus the Swiss franc at 99.04. The dollar's up 0.25% versus the yuan at 6.75. Have a look at the ruble. The dollar is at 57.80 versus the ruble. So the ruble is still very firm. A couple of weeks ago, the dollar got up to 66 when the Russian central bank cut rates, and now the ruble has appreciated. Aussie dollar this morning is testing the 70 level, is down about 0.5%. Canadian dollar, the dollar is up a third versus the Canadian dollar, 128.25. And the Kiwi dollar is down 0.5% at 63.24. We'll finish with the commodities today because we've seen where the bond markets are. We got WTI crude down about 2%, 116.33. Brent crude is down 2% as well at 118.53. High-grade copper is down 1.5% at 4.24. And U.S. nat gas is down 3.5% at 8.52. Yeah, this is short-term noise for commodities, of course. And I still, as I said, expect hard assets to continue to shine for the next decade, I would say. That's my opinion. I think commodities bottomed in March of 2020, and we've got a long way ahead. While the general stock market is going to not perform as well as it has in the last 20 years, and bond markets will be even worse, I think. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And yes, I wish you all a great day. Take care. Bye.